The first recommendation that I would make to you as you go about this important task is that you draw on the available resources that are already in place. A number of organizations and bodies have looked at ways to simplify and improve the tax code. Many of my suggestions today are drawn from that, and there's many, many other suggestions there that I don't have the time or space to deal with, but I strongly recommend to your consideration. These include the President's Advisory Panel on Federal Tax Reform, which submitted a report in November 2005. It includes reports on tax simplification by the Joint Committee on Taxation in 2001 and 2005, and the annual reports of the National Taxpayer Advocate. I'll now go through several approaches that I think will be fruitful in simplifying the tax code and making it work better for the American people. One suggestion is to simplify family and work benefits. Current law has several provisions that attempt to aid low-income workers and parents. These include the Earned Income Tax Credit, the Child Tax Credit, including the refundable Child Tax Credit, the Making Work Pay Credit, and so forth. The complexity of these rules is well known, and I strongly urge consideration be given to consolidating them. There's a number of proposals out there for how to do that. I am particularly attracted to the general approach taken by the President's Advisory Panel of consolidating those provisions into two, a family credit and a work credit. Related to that is my next suggestion. I believe it would be best to avoid income-based phase-outs. The current tax law has numerous provisions where particular credits or particular deductions are gradually phased out as people's incomes exceed particular thresholds. The intent of this, of course, is to impose additional taxes on high-income people, but I believe it's an inferior way of doing this. Phase-outs basically penalize the earning of income in the same way that just openly and explicitly raising tax rates would. But the phase-outs are more complex and less transparent. The instructions for Form 1040 and for various Form 1040 schedules are filled with worksheets on which people have to compute each of these applicable phase-outs. Nobody understands these phase-outs or how they work. Ideally, my recommendation would be that there should be no phase-outs in the tax code except in the family and work credits that I mentioned a minute ago. For other provisions, including saving and education incentives, my preferred approach would be to make those incentives available either at all income levels or at
if those incentives were designed to be progressive in some way, it would just say, hey, the complexity cost of progressivity is such that we just can't do it?
No, what I would say, I think, is that the progressivity could be achieved without the complexity by adjusting the income tax rate schedule.
Okay.
There's no need to sacrifice progressivity. That decision of how progressive the tax code should be, how much of the burden should fall on the rich, and so forth, can be made separately from this. The income-based phase-outs really play no necessary role in achieving progressivity. And I'm glad that question arose because I want to stress that as a general point, that many of the proposals I'm making here today by themselves could alter the distribution of the tax burden between rich, middle class, and poor, but any of those shifts, if desired, could be undone simply by changing the rate schedule. And therefore, I don't think that those effects should be viewed as impediments to adopting these, nor are they motivations for adopting them. The goal instead is just to find a simpler way to provide the desired degree of progressivity. On a related note, I suggest simplifying education incentives. Current law has numerous provisions in this regard as well, things such as education savings accounts, the student loan interest deduction, the HOPE tax credit, the lifetime learning tax credit, and so on. Once again, it would be possible to consolidate these into one or two provisions. On a more minor note, a number of commentators have pointed out the discrepancies and disparities that have arisen concerning whether MBA tuition is a deductible employee business expense. The tax court has ruled on several cases recently, allowing a deduction in at least one case, but denying it in others, based on circumstances that seem to be relevant under current IRS regulations. But which lead, I think, to unpredictable results. And I think that could be clarified either by statute or by regulation, and might well become moot if the broader simplification of education provisions takes place. On exactly the same note, I would recommend the simplification of savings incentives. We're all familiar with the alphabet soup of savings accounts that exist. IRAs, 401ks, employer pensions, simple IRAs, health savings accounts, medical savings accounts, education savings accounts, and so on. Once again, these could be consolidated into 3 or fewer provisions. The Bush administration had a proposal in this regard in 2004, the President's Advisory Panel in 2005. And once again, I think different policies could easily be accommodated into whatever simplification is adopted. Many people, for example, have expressed concern that the tax code should promote employer-based savings plans, which may have broader participation than purely individual savings. But again, that goal, if desired, can certainly be achieved by having one provision for employer plans and 1 or 2 for individual saving, all of which would be simpler, and making the employer provision more generous as desired so that its role is maintained. More generally, I have a number of proposals just sketched out here on how to simplify calculations that are done on tax returns, both individual and business. Today, we have reduced rates for dividends and long-term capital gains, which require a lengthy worksheet in the Form 1040 instructions, which almost defy human understanding to get through, with different rates applied to capital gains and dividends, depending upon what bracket a person is in. A much simpler approach would be to pick a particular percentage and simply tax that fraction of dividends and capital gains, so perhaps tax half of them. Similarly, with Social Security benefits, there's an income-related phase-in where 0, 50, or 85% of benefits may be taxable, and it would be much simpler to have a flat percentage taxed. Mutual fund shareholders encounter difficult computations to determine whether all of their foreign tax credits on international mutual fund holdings are creditable or not. Congress has provided a simplified method that applies to people with relatively low amounts of mutual fund income. I think it would be desirable to expand that to reflect inflation that's occurred over the years and also the greater participation of ordinary Americans in mutual fund markets. The child care credit is rather complex in its current form. It again is income related with different percentages of credit. As a work-related expense, it makes sense to provide tax relief for child care costs, but the simplest way to do that is through an above-the-line tax deduction, available both to those who itemize and those who do not. The research tax credit is structured in a very complicated incremental manner, linked in large part to the amount of research spending that the firm did in a 1984 through 1988 base period. I join many people in calling for its replacement by a simple flat percentage credit.
And is your view that the complexity of doing the R&D tax credit, the reason they designed it the way it is was to try to encourage not to reward for R&D you were going to do anyway. Is your view that the complexity of the R&E tax credit has an impact on the take-up rate or something in the way we might think of tax complexity on the individual side, like the earned income tax credit? If it's too complicated, a bunch of people won't use it.
I'm not sure
that's true on the business side.
I'm not sure that that is true. I mean, if there is a take-up problem, then obviously that would be an additional argument against the incremental credit, but I would not rely upon that effect, which may or may not exist. I think that instead the structure of the credit has a couple undesirable effects. One is that it provides different incentives to different firms based on whether they're above or below their base period amounts in just a crazy quilt manner. And second, that it simply adds additional complexity, particularly the effort to reconstruct 1984 to 1988 spending. The regulations stipulate that the 1984 to 1988 research spending must be computed on the same basis as current year research spending is computed, so that every time the IRS changes the regulatory definitions and standards for research spending, ostensibly taxpayers are supposed to recompute their 1984 to 1988 spending on that basis, using criteria that were not known at the time and which can scarcely be reconstructed with accuracy this many years after the fact. There's also a set of complications and perverse incentives that arise with respect to firms that have been newly established since 1984 to 1988. So those are the concerns, not so much any impact on take-up. I have a number of suggestions that I group under the category of eliminating unnecessary complexity. These are provisions that even if you agreed with their stated purpose, which I do in some cases and don't in others, simply are designed in a way that do not serve that purpose effectively and instead create complexity. The credit for the elderly and disabled, for example, is intended to provide additional help to that demographic group, but as currently designed, the credit is available to very few taxpayers. If there is an objective of providing additional support for this group, there are simpler ways to do it, such as the increased standard deduction for the elderly and for elderly taxpayers. Now, as I state in the tax notes volume, I'm actually opposed to that provision because I believe that we should not be providing special tax breaks to the elderly, but instead should lower tax rates at all ages. But again, even if you disagree with that judgment, this particular provision is complex and unnecessary. There are other ways to help the elderly if, contrary to my position, that's a desired goal. We've recently adopted a provision allowing non-itemizers to deduct a modest amount of property taxes, which simply adds, I think, additional complexity to the tax return. The taxation of gambling winnings and losses is also a source of needless complexity. The provisions are compliance-proof. No person has ever complied with the statute and regulations governing the tax treatment of gambling winnings and losses. In my opinion, it would be reasonable to simply ignore the gambling transactions. As an alternative, one could approximate what people actually do, which is by taxing only those large winnings for which information reporting is currently provided. The small business stock exclusion is designed to help small business, which, as I'll explain in a moment, is not a goal that I share, but it is clear in any case that this particular provision is extremely complex, provides a small capital gains tax rate to an extremely narrow set of firms, and seems unnecessary, particularly in view of the preferential capital gains rate that now applies across the board.
And so your view is that it is complicated. I had thought someone had told us that it was difficult to qualify, but if you qualify, not especially complicated. Do you think that that's a...
Oh, I think that's fair. The complexity is in the qualification criteria, yes. With respect to the size of the business and so on, and the required holding period and such. Let me make a few remarks about business tax reform. Although a few of the items I've mentioned relate to business, most of my discussion so far has been individual. The key goal in business taxation is neutrality. There should be equal effective tax rates imposed on different types of income, different industries, and different methods of financing. Economists use the term production efficiency to describe what we're trying to achieve here, but I can put it, I think, into simpler terms as saying that we want to let the market pick the winners and losers. We want those investments to be chosen that have the greatest profitability based on non-tax factors. In other words, those that meet consumer needs best in the marketplace, rather than those that happen to qualify for preferential tax treatment. Along those lines, I would eliminate various energy tax credits, export subsidies, and the domestic production tax break, which is designed to favor goods over services. I would also end a variety of measures that discriminate against big business, or I guess as it's commonly phrased, help small business. The myth that small business is uniquely the engine of job creation has been discredited by one economic study after another. It is true that small businesses face unique compliance and administrative cost challenges, and it's reasonable to provide relief on that front. But the substantive taxation, to the extent possible, should involve the same tax rates on large firms and small firms. And that would involve eliminating various breaks for small firms with respect to exports and oil production and expensing of equipment purchases.
And does that influence your view of all the variety of forms of pass-through entities?
In part it does, because I should say that I've set aside the big questions, such as whether one should have a separate corporate income tax, whether we should be taxing income as opposed to consumption, and so on. But I think you can view the existence of a separate corporate income tax, which imposes a second layer of tax on publicly traded firms, essentially, while having only a single level of tax on pass-through entities, as itself being a type of unjustified discrimination against big business. It's not always effective, even on its own terms, because some entities subject to the corporate income tax may actually not be large, and some pass-through entities may not be small. But I think it does reflect that same flawed logic. To the extent that a big change of that kind is within the agenda of this body, I would definitely recommend consideration of some type of corporate tax integration.
Just to state for the record, our charge as a subgroup is to come up with ideas that will go to the full board, but nothing will be in the form of an outright recommendation. It's simply to consider various options, what are the pros and cons, and we take that as a point for the record to, might be worth examining that.
Thank you. Along the lines of neutrality in business taxation, I also would recommend removing the tax penalty on inventories. Inventories that claim the LIFO method of accounting actually pay an effective tax rate that is comparable to the tax rate on plant and equipment. Inventories that are treated under the first in, first out method suffer an extremely high effective tax rate, which is a clear departure from tax neutrality. Some firms are driven to use first in, first out accounting on their tax returns because of the requirement that any firm using LIFO on its tax returns must also do so on its financial statements. We impose a requirement of that kind for no other business tax provision, and it's actually going to become particularly problematic if we adopt the International Financial Reporting Standards, whether in 2014 or later, because LIFO is not allowed as a financial statement method under those standards. I'd like to just throw out a couple of cautions in approaching business tax reform, because I think it's easy to lose sight of the goal I've articulated of equalizing effective tax rates across different industries and types of income. Some people, for example, have viewed base broadening and lowering the rate as an end in itself. But in fact, the goal is to equalize effective tax rates. If particular industries or types of income are getting preferential tax treatment now, then ending that preferential tax treatment, which is a way to broaden the base, and then using it for rate reduction is, of course, extremely desirable. But one sometimes hears proposals for base broadening that actually tilt the playing field instead of leveling it, that raise tax rates on things that are already taxed more heavily than other investments. Proposals to repeal LIFO are certainly the epitome of that flawed approach, in my opinion, since it would increase still further the tax penalty on inventories. And although today's topic is simplification, which I think is very important, I do think it's important not to give undue weight to simplification in dealing with business income taxation. Of course, it's a legitimate objective, because we want business tax returns to be as simple as possible. And some of these reforms that equalize effective tax rates will also promote simplicity. And I think that is something we have to search for. But there is probably limited scope for simplification simply because business income measurement is inherently complex. So we should look for simplification opportunities where we can, but we should not adopt simplifications that introduce substantial economic inefficiency by causing effective tax rates.
When you say effective tax rates equalize, are you talking across sectors, across size of firms, across, what?
All of the above.
All of any
above.
place. We have
Yes.
size preferences,
Right.
we have
But it's
industrial
impossible to
preferences, we have
equalize all of
export
them,
preferences.
obviously.
The goal would be to equalize all of them. It's impossible to equalize all of them, but ideally, all capital income should be taxed at the same effective rate.
Okay, I just wanted to.
Of course, it's a goal that can only be
We just have the
approximated.
complexity that you sense there's all this international
Absolutely.
variation in
Right,
tax rates. So
right,
getting
right,
the effective
right,
tax rates
right.
equal
Right.
has proved a challenge.
It's a challenge. I guess maybe a better way to state the practical goal is simply to eliminate those disparities that we can easily eliminate. There's so many disparities
Okay.
today.
If you
I
start
think
at the
there's-
goal, you'll make
there's
some progress.
There's some low-hanging fruit.
right.
Well, I'm almost out of time, so let me just, I've not spoken to compliance. I think it's important, but I'm not an expert on it. The one compliance suggestion I would make is that there is a pressing need to prevent and prosecute the evasion of income tax on offshore interest income. And I support the approach set forth in President Obama's fiscal 2010 budget to crack down on this type of prevalent tax cheating. Thank you.
All right.
Okay, thank you, Alan. And I appreciate you
Yes,
staying,
thank you very much. Yes,
keeping us on
very clear
time.
and, yeah.
Who's next? The Small Business
The
Coalition.
gang.
Okay.
We picked straws and you've got the straw.
How'd you get them?
I don't have any handouts for you guys, but I will
Okay.
have something for you.
Okay, first,
Put on the website.
everybody
Good, okay,
introduce
we'll-
themselves,
yeah.
discuss. Yeah, if you give us anything you would like us to circulate, we're happy to do so.
Will do.
Yeah, introduce yourself.
Giovanni Cortolo, I'm Vice President of Small Business Policy for the U.S. Chamber of Commerce.
Bill Risch, I'm the tax counsel with the National Federation of Independent Business.
And I'm John Satterjee, I'm president of the Small Business Legislative Council.
Okay, great.
Those guys.
You ready to go? Like John said, I drew the short straw, so I get to do some of the talking, although they're going to fill in. So, well, the deal is they have to answer all the questions. So they didn't realize that. I just came up with it now. So between the three of us as well, in addition to each representing business organizations, we've all worked together very closely with a coalition that we formed back in 2007 called the Coalition for Fairness in Tax Compliance, not to be confused with, it's the CFTC, not to be confused with the Commodities Futures Trading Commission. We don't have anything to do with commodities, futures, or trading. And we formed this really in response to a lot of concerns that were coming up at the time over the tax gap and attempts to improve compliance as well as enforcement. And these policies were hitting especially hard on small business, and we've worked with a number of other business organizations around Washington to address some of these issues. And they really get to a lot of the issues we have discussed over the last 2-3 years relative to the tax gap, get to a lot of the simplification and compliance issues that your group is going to be focusing on. So we think we've already done a little bit of spade work on this, and I'd like to share with you some of what we found, and we really appreciate the opportunity to be here today to discuss some of these issues. Since we do represent small business owners, small firms, we do realize the importance that they play in the economy, as the overall national economy, 50% of the GDP, as well as the importance they play in communities all across the country. There's not a town in America that's not built around a small business, so they're the restaurants, retailers, small manufacturers all around the country.
Just for clarification, so what's the range of size you're talking about?
That right there is the million-dollar question when you talk about small businesses. The SBA definition is 500 employees or less. As you dig through various laws, you can find
different ones. So part of it is basically,
as Alan just said, there are
Tax code has
okay.
several.
yes.
Fine. So one of the big issues is what is small. And
So what is small? And you know, each small business is going to be a little different. Whether you're talking about the single sole proprietor versus a manufacturer with 500 employees or a construction firm with 300 employees, they're going to have very different issues. So it really means that a lot of what we do is herd cats. So because we've got so many different issues. But one issue that is common we see across the board for small business owners, the tax complexity is a major problem for small business owners. The Small Business Administration Office of Advocacy did a study finding that the compliance cost for small businesses relative to large businesses is about 67% higher for a small firm. Part of this is due to the paperwork burden. At the National Federation for Independent Business, we do regular surveys and polls through our research foundation. When we asked small business owners what's the most expensive paperwork burden imposed on you by the federal government, tax paperwork is the #1 burden. So it's a major expense. The other issue you really have to deal with, especially depending on the size of the business, is that a lot of that paperwork is being done by the owner. To the degree that the owner is spending his time filling out paperwork, these folks, your owner is working kind of shoulder to shoulder with the workforce. They're dealing with customers, they're filling orders. They're not sitting in an office necessarily dealing with papers. So they don't have a finance department to deal with these issues. So they're dealing with them on their own. So it does take away from the productivity and the core mission of the business. And that's why when we also surveyed, we found 88% of small businesses outsource this to an accountant. They outsource their tax services, 88%. So it's a pretty, that's an additional expense. And to the degree the questions come up about tax issues, they're going to have to turn to an accountant to look at those. We also poll at the NFIB. We ask we send our members 75 issues, and we say rank them. Of the top 10, 3, 4, 5 were all tax issues. Number 3 was the federal tax burden is too high. Number 4 was the property tax burden is too high. And number 5 was tax complexity is too severe. So
Tax complexity
was number 5 out of
So it's in the
70.
top-
So
it's in the top five.
So 3 of the 5, for sake of rounding it out, 1 was healthcare costs and 2 were energy costs. So, so really tax compliance is a big issue for small business owners. And also the tax rates. And really the way some of these pieces work together is, cash flow is of big importance to a small business. The money coming in the door is the money you use to operate the business. So to the degree that tax rates are high or compliance costs are high, you're drawing more money away that keeps the business going. So it is an important issue to keep in mind, that cash flow issue, and especially when you start dealing with things like payroll taxes, that really imposes a year-long burden on a business as those taxes become due. One other sort of general premise that sort of surrounds small business owners is it's oftentimes hard to separate the business from the business owner. 75% of small businesses are organized as pass-through businesses, so the individual tax rates are the rates these businesses are paying. And as I said, it's really the owner who, serves as an HR department, as a finance department. So a lot of the tax issues that a larger business may be sending to a particular department are being handled by the small business owner. So it means the business owner has to wear a lot of hats, and they have to pay a lot of attention to these issues. And like I said, it pulls away from their core mission of really running whatever the business is: construction, manufacturing, retail, restaurant, whatever it might be. Over the last couple of years, we've seen a lot of interest in tax compliance, and there have been a number of proposals that have come out of the Treasury Department and Senate Finance Committee, House Ways and Means Committee, Joint Committee on Taxation, dealing with these compliance issues. And what we've seen with those is, while they're all well-intentioned, they tend to exacerbate these problems that I was talking about earlier. They tend to increase the paperwork burden, things like increased reporting on Form 1099 for services that are provided by a business, increased reporting from banks and merchant card providers. These all add to the cost of compliance. They're new paperwork burdens, and they make it more difficult. As I said, tax paperwork burden is the most expensive that small business owners have to pay, and these only make those costs higher. So I really think what we need to be looking at to increase compliance is also to increase simplicity. So I think the two really kind of intersect. So when you talk about having simplicity and compliance as part of the core mission of your group, I think the two at some point intersect. The easier it is to file your taxes, the easier it is to comply, and the less questions you have to ask. So really, when you look at a small business and you start thinking about, okay, how do we simplify to improve compliance, you really just sort of have to look at the general equation of what the business owner has to think about. And it's a very simple equation of your gross receipts minus your expenses that get to your net receipts, and that's where you apply the tax. So really the two places you can have an issue are at the gross receipts area. So what is gross receipts and how do I report it? And the second area is what are my expenses and how do I deduct them? It's the deduction area, I think, that really raises a lot of issues. As the previous speaker just mentioned, as those deductions sort of become whittled down to hit a specific area, we make them more and more complicated and more complex, which creates the opportunity for more mistakes, or even in some instances, more opportunities to maybe game the system. So I just want to touch on a couple of those issues and where we can improve on some of the complexity of the important deductions that a typical business owner is going to be claiming. I want to start first with accounting rules. Currently under the tax code, as we said, there are a lot of ways to define a small business. One of the provisions allows for cash accounting, which is a simplified accounting method for a business with gross receipts of $5 million or less over an average 3-year period. That is a much more simplified way of accounting for your money coming in the door and your expenses that are going out. We would recommend increasing that to maybe $10 million. This meets with some of the growth in businesses. It would include more businesses under that cap, and it would really simplify the way a business is accounting for its expenses on its books, and it's accounting for its expenses for tax purposes, especially at the small business, within the small business level. Let me hit on a couple of the expensing deductions that sort of fit in with that. Number one is Section 179 expensing. This was a provision that in, I believe, 2003 was increased from a deduction of $25,000 to $100,000 tied to inflation, and currently under the stimulus bill is $250,000. And what makes expensing Section 179 so important to small businesses is that it does two things. One, it puts money immediately back in the business. 179 expensing replaces depreciation. So it allows the business owner to take an immediate deduction for equipment that they use in their business. That does two things. One, like I said, it puts the money right back into the business in the year that they make the expense, rather than doing it, say, over a depreciation schedule of 10 years or 50 years or 30 years, whatever the life may be. The other thing it does is it simplifies things. You don't have to keep track of what depreciation schedule am I on, how much have I depreciated, how much do I have to go, what's the recapture issue if I sell the item on the back end. It really simplifies the ability to take that deduction, and it does what's really important for a lot of businesses. It gets the tax benefit on the front end rather than on the back end, and that's an important part of creating these incentives to make the investments in the business and simplify the code. That increased amount will expire at the end of 2010. So at the end of 2010, we'll go back down to $25,000. Making that permanent, I think, would be a big benefit. Like I said, it's currently tied to inflation, and so it'll be about $130,000 with some plus up next year. Currently, it's at $250,000. Increasing that and making it permanent, I think, would be a big benefit to a lot of businesses, a lot of small businesses.
Do we have good studies on the or would you recommend some on the effects of that? I mean, what's the, so went to 100
Yeah.
in 2003. It just recently went to 250.
Right, it went to 250 in the stimulus.
In
It went to, in the
stimulus.
stimulus bill in
Right.
2008.
So do we have some idea of what happened when it went from 25 to 1?
We
and
do.
then
If
stayed
you,
there for a
actually,
while?
the one place you can look for this, because there hasn't been a lot of studies done on it, and I think looking into that and the economic effects of that would be important. One place you can look is the statistics of income data. Looking at them, I think from 2004, sole proprietors had the biggest increase in depreciation deductions taken since the 1986 tax reform bill. I think there's a clear tie to that increase and the simplification going together. Now, this has been done especially, mostly for equipment is what the expensing's been on, but this isn't on property. I think there is some value in looking at taking a deduction for property as well.
Property as well.
You know, a lot of business owners, a lot of our members that we've talked to have said, look, you know, I'm kind of all propertied out, I'm all equipment out. I've bought a lot of new equipment, printers, you know, fax machines, et cetera. But I'd like to do some changes on the structure of my business and be able to fix some of that up. And we've seen some of that in the extenders bill for retail and restaurant properties that get instead of a 30-year depreciation, they get a 15. And that's been added to the extenders bill for the last couple of years. And one of the benefits there is that more closely matches the life of the business. You get a lot of wear and tear with a restaurant and a retail business. They're open longer hours, they're open more days, and they get more foot traffic. So they're getting a lot more wear and tear than, say, an accountant's office or an architect or something like that. So it really does match up better with the business. And I think looking at a lot of those depreciation schedules and figuring out which of these match, which of these don't match, or are there a way to simplify this. You know, one of the things I would encourage you to look at is a GAO report from July of 2007 on sole proprietor compliance. There's a chart included in there that shows where mistakes in a return were made. And it goes through the deduction section. And 2 of the 4 top mistakes in deductions were under depreciation and vehicle expensing. Now, I'll talk about vehicles here in a second if I have a chance. But you know, depreciation is a very important part, and it has an opportunity to really be an area for mistakes. So some improvements there, I think, would be a big help to business. And it would also encourage investment as well. Another issue I want to hit on are home offices. We see more and more businesses that are run out of the home, whether it's because of technology, stay-at-home moms who want to make extra income.
Right.
There are a lot of opportunities for people to work out of the home. Unfortunately, the deduction for the home office is a maze of confusion.
Yeah.
And it has long been
That's
thought
not
of
true.
as a red flag for deductions. We in fact did a survey of business owners and asked, if you have a home office, have you taken the deduction? And if you haven't, why haven't you?
Yeah.
And the number one reason was, I heard I might get audited. So the complexity of it, I think, really gets at the heart of it. The forms that go along with the deduction itself, you have to claim the deduction on a separate form. I think it's at 8826. And the one-page form refers you to see the instructions 14 times to fill out a one-page form. There's a 5-page explanation for what a sufficient business purpose is relative to the home office. And there is a detailed way of measuring the space you're using, and you have to make sure that it's exclusive. So if you have a spare bedroom and you have your in-laws spend the night in the spare bedroom, you may fall out of being able to use that as your home office because now you're also using it for personal use. So it is an area that is a lot of complexity. It's an area where we see a lot of growth for small businesses and a lot of opportunities. We have supported a standard home office deduction. You could continue to run through with the current system if you like. You know, if you like, you know, reading, you know, 80 pages worth of forms, hey, keep going, keep doing it if that works better for you. But if you want to do a standard deduction, we think there's a lot of incentive there to take an expense, and it's a deduction that's going to be very important to the business because oftentimes that expense is going to be a large part of the business, especially
Now,
right now.
in these 2 cases of depreciation allowances and home offices, the reform you're describing is actually 2 parts. One is simplification, but one is a tax cut. So with depreciation allowances, to convert it to immediate expensing,
Yeah.
will lose revenue
Right.
unless, do you think that the issue of complexity is sufficient that if in some sense the rates were higher or wasn't, it wasn't a you didn't get a 100% deduction, but it was simple,
Yes.
such that it kept revenue
Absolutely.
the same? Do you think small
We
business
think
would be
that
very...
small businesses would trade complexity for
that.
the
Yeah.
100%
To keep
amount.
the average
They've done that
price.
time and time again.
Yeah.
The telephone tax is a prime example of that.
Part of it is also matching up with the way your cash flow goes. I mean, it's driven by that as well as other
Right.
things. So
Yeah.
if we can get it that way, we're good.
And the telephone, you mentioned the telephone.
Well, the telephone tax was a prime example of where small businesses could care less about trying to get the exact dollar amount recouped
Yeah.
by filing all of their back
All their-
telephone
all
bills.
their bills, yes, no.
Rather, they took a
Just very-
simplistic
I see.
approach. This was
And
a,
this was,
it wasn't a-
this was the repeal of the excise tax.
Right, right.
About 3 years ago.
The
I
excise
think. So it was
tax,
506. Speaking of phones, since we're on that,
Right.
since we've discussed phones, cell phone deduction is another area where the law hasn't kept up with technology. Currently, you have to go through your phone bill line by line, which one's business, which one's not business, minute by minute. You don't buy cell phones that way. When this law was put in place, many businesses that required someone to carry a cell phone, it was usually considered, for your sort of senior employees. Now, a lot of employees are carrying a cell phone. We've supported efforts to make that easier, just deduct the cost of it. The IRS has asked for comments on that just recently.
This would be the cost of the phone?
The cost of the monthly
The cost
bill.
of the monthly
Yes,
bill.
yes, exactly. Instead of going through line by line, call by call. You use your phone at work, you call home and say, hey, I'm going to pick the kids up from soccer practice. You don't have to. If you do that on your cell phone, that's a personal call, not a business call. You've got to exclude it. I think there's a
And this
simpler
would be
way
a
to do it.
rule that would apply only for small business, or that would,
This would be
cell
broad.
phone would
This would
be a broadly defined
exactly.
form of
This is not
compensation?
small versus, but the reason we think this is important to small business gets to that complexity issue. The less paperwork you have to do, the less filing you have to do, the less questions you have to ask of your employer, the easier this process becomes. I mentioned the vehicle deduction as one that creates a lot of complexity, and there's been an opportunity for mistakes there. Again, the more you whittle those deductions down, the more difficult it becomes. There are different ways to account for the vehicle deduction, whether it's through depreciation of the vehicle, hours traveled, and then there are limitations based on the size of the vehicle. There's really very few small businesses. There are very many small businesses, I should say, that are going to claim a vehicle deduction. It's a necessary part of the business. Whether you're at a construction company hauling equipment, you're at a restaurant and a caterer, and you're driving food to the event. This is a pretty regular expense for a lot of businesses, and simplifying that as well, we think would make a lot of sense because it goes at the heart of what is a very important business deduction. Two other areas that I think create a lot of complexity, and I don't want to spend a whole lot of time on the first one, and that's employee benefits. As was mentioned previously, the alphabet soup of retirement plans is confusing. The ability of small business owners to participate in many of those is limited. There are some benefits under things like a simplified 401k plan that provide additional benefits for small business, dealing with anti-discrimination rules that allow the business owners to really create a pool to run a 401k plan, but there are a lot of challenges setting those up and making sure you're meeting the rules in the right way. So some simplicity there is important. I would say the same. I shudder at discussing healthcare, but healthcare is another issue, but there are a lot of tax issues that surround the providing of healthcare benefits. One thing in particular, if you are the owner of a business, it's a pass-through business, you generally cannot be included on the plan. You have to take that as an individual deduction, which means you have to claim it separately, and the deduction is not as generous as it would be for your employees. There are proposals in Congress to create some level playing field between the business owner and the employees. We think that's an important issue. And we think it also is an important issue relative to entrepreneurship. If you work at a big accounting firm and you want to go out and take a couple clients, and start your own business, you shouldn't have to be nervous about where am I going to get my health care from because the tax treatment is going to be different. So that's another issue, but I just wanted to touch on employee benefits very quickly. One other area where complexity is an issue and something that's very important to small business owners is the use of independent contractors. This has been an issue that has come up over the years. It is a tax issue, it's also a labor issue, it's also a benefits issue, so again, a lot of these things overlap, but there's currently a 20-factor test that the IRS uses to determine who is and isn't an independent contractor. We think some clarity there would be very important. It would help to give business owners a lot firmer footing to know where they stand relative to who they're hiring, when they hire. An independent contractor plays a very important role in the small business economy, in two ways. One, if you're a small business, you might not need someone full-time to do a particular task within work, so you may have to go out and hire someone to fill that specific contract. At the same time, a lot of people who are entrepreneurs, a lot of people who want to start a small business can use that opportunity to be able to fill those tasks. Maybe it's IT work or it's delivery services, whatever it might be. There's an opportunity for them to go out and win those contracts and fill in the gaps within the small business economy. So providing some clarity there can go a long way to letting an employer know where they stand relative to who is and isn't an employee. There is then when you have a test that's that unclear, and not only do you have a 20-factor IRS test, you have a Department of Labor standard, you have state standards, so you've got sort of this patchwork of what rules am I playing by. That kind of shifting of standards is not helpful for small business or big business for that matter. So we think there needs to be some standardization there, some clarity within that law. Two other quick things. Another issue that, as I said, in terms of separating the business from the business owner, since about 75% of small business owners are organized as pass-through businesses, there are sort of two unique things that those types of businesses need to keep in mind. One is the estate tax. If you are a family-owned business and you want to pass the business on to the next generation, if the next generation is working in your business, you're going to have to think about the estate tax, what your succession plan is, and if the business continues to grow above what the exemptions are, and how it is that you're going to deal with that when the tax comes around. The estate planning side of things becomes very challenging, very difficult. It's an added expense. It's an added issue that the business has to consider, and it can become a big hit if you're not planning for it properly if you pass that business on to the next generation. So it is an issue to consider. It is an issue to think about relative to complexity and planning. The last thing I really want to hit on relative to this pass-through business issue are the individual rates. As I said, 75% of small businesses are structured as some kind of a pass-through business. So they're not paying a corporate tax. And I know part of the board's mission is to look at corporate tax reform, but this is not a tax that the majority of small business owners are paying, as the previous speaker mentioned.
Right.
And there's a reason for that. A lot of small businesses, it's going to be harder on the cash flow basis to pay two levels of tax. One level of tax makes a lot more sense. And I think when you look at the growth we've seen in S-corps, and the number of LLCs that have been created since 1986. I think these have been a big driver for entrepreneurship and opportunities for business owners to manage their affairs in a reasonable way with liability protection and the benefits that come along with being some kind of a structured business. There's a lot of talk relative to reducing the corporate rate and then how the individual rates stand. I think there needs to be some consideration given to the fact that if you reduce the corporate rate substantially and you continue and you raise that individual rate, not only the individual rate at the federal level, but then you also stack on state rates, there could be a big disparity between the corporate rate and the individual rate. And I think that's something certainly to consider relative to tax planning opportunities and what impact that may have for businesses choosing to incorporate versus choosing not to incorporate. The tax reform, the tax notes recently put out a tax reform piece. Georgianne wrote a piece on this, mentioned that Section 341E of the code was repealed to deal with this a couple years back. This, when you talk about simplification, 341E was notorious for having a section that had one sentence that was longer, that was twice as long as the Gettysburg Address. So when you're talking about that kind of disparity, try to make sure you're not planning around these issues. That's where complexity comes along. So I would certainly say to keep that in mind when you're looking at these varying rates between pass-through businesses versus corporate businesses. If these two gentlemen have anything to add, I'll let them jump in.
Well, just a couple things. Know that 99.7% of all firms are small businesses, and we firmly believe that 65% through BLS data, 65% of all net new jobs do come from small businesses. So how we attack this, how we make changes are going to be very important. I think with the marginal rates, you have to look at this as an access to capital issue for small businesses. Small businesses grow based on their marginal rates. You take any portion of income, a portion of that goes to maintaining their house, their lifestyle, and their access to capital and growing their businesses start at the marginal dollar above that amount that they use for their personal lifestyle. So small businesses grow at these marginal rates, and any increases in that only exacerbate the problem. Predictability in the tax code is important. If you don't have if you don't know the tax consequences of economic activity, you're not too endeared to make those judgments. So that's very important. Complexity, and certainly I concur with everything that Bill says. And John, I don't know if you have anything to add.
Well, I think it's one important point, one single point that I'll put on the record for the three of us, and that's we do not share the view that the myth of small business as a contributor to the economy has been dispelled. Let's make that very clear. We are an important contributor, and the tax code and our relationship is very important to continue that role. So we don't share that view.
Okay, well, thank you
Great.
very much.
All
This
right.
is some
Yeah.
very interesting material for us to
Yeah, thank you.
examine, and
Really,
Thank you.
very wide-ranging.
and we appreciate you also staying on
Yep,
our time.
yep, great.
Marshall.
Hello.
Good afternoon. I'm Marshall Hunt, Director of the Tax Assistance Program for Accounting Aid Society in Detroit, Michigan. I'm a CPA with 34 years of experience in tax administration and 20 years of volunteer experience as a volunteer site coordinator before I joined the staff of Accounting Aid Society. I appreciate the opportunity to be here this morning. Accounting Aid Society provides free tax assistance and helps the economic self-sufficiency of low-income families, seniors, and others in need in Detroit. In 2009, we served almost 14,000 low-income families and individuals and returned $14.8 million to the local economy. We provide electronic filing of tax returns as well as links to asset building and other services. We are proud to be a IRS VITA program that's volunteer income tax assistance and also a low-income tax clinic. I recognize there are large dollar and complex issues for you to consider, such as the alternative minimum tax. However, my comments are going to be directed to the specific issues affecting low-income taxpayers that I've observed in over 30 years of assisting them. My comments are my own and not necessarily the comments or views of Accounting Aid Society. In considering any legislative changes affecting low-income taxpayers, I urge you to extend the benefits provided by the American Recovery and Reinvestment Act, as well as continuing to support the IRS in providing free assistance to taxpayers through the VITA program, the Tax Counseling for Elderly, as well as supporting the Free File Initiative. For those with tax controversies or English second language taxpayers needing information, the low-income taxpayer clinics are funded by IRS, are extremely important. We need tax provisions that will be in effect for more than 1 or 2 years at a time. I remember a time when major tax changes were not nearly as frequent as today. Much of the complexity for individuals arises from frequent changes. Recognizing that the economy, budgetary restrictions, and abuse prevention are drivers behind frequent changes, the overall burden to the taxpayer needs to be considered. For example, the change in the definition of qualifying child provided by the Fostering Connections to Success in Increasing Adoption Act of 2008 requires someone other than the parent to have an adjusted gross income higher than that of the parent in order to claim the qualifying child. I believe this provision was well intended, but it requires taxpayers to obtain information such as AGI from another party that they don't understand or have ready access to. explaining to the grandmother who properly claimed a grandchild in 2008 that they can't do so in 2009, even though the facts are the same, will not be an easy task. The new and increased refundable credits by ARRA provide new incentives for obtaining earned income and undertaking education. However, most are only in effect for the years 2009 and 2010. For example, the American Opportunity Credit now covers 4 years of higher level education. However, it is only in effect for 2 years. I'm looking forward to this next tax season when I can tell a low-income taxpayer with no tax otherwise due that they will get a benefit from their education expense, or that they can get an additional child tax credit or an increased earned income credit. However, I would like to give them some assurance that these additional benefits will be ongoing. Tax planning is not restricted to higher income taxpayers. Some might argue that there are too many options for education expenses in terms of credits and deductions, and a computer is now needed to determine the best approach. I'm not going to propose a limit on those options, as there might be tools needed for various situations in obtaining education. However, the underlying expenses should be the same for each option, assuming we keep several options. For example, books are now allowed, and books are a very high cost for most students. Books are now allowed for the American Opportunity Credit, but not generally allowable for the Lifetime Learning Credit or the tuition and fees deduction. A uniform definition of education expense, similar to the uniform definition of qualifying child, would simplify the choice of options. Some simplification in individual deductions could go a long way in eliminating some of the mystery of the tax law for individuals. For example, there is one business mileage amount, but separate mileage amounts for medical expense, charitable mileage, and moving expense. It would be much simpler to have a business mileage amount and one standard mileage amount for individual non-business deductions, both indexed to the same inflation factor. A look at family situations and age requirements in the tax law should be considered. Taxpayers are working longer. Is a age 64 cutoff for earned income credit for a person without a qualifying child still valid? Our minimum distribution age is still there when people are working longer. Is the under 13 age for a child independent care credit still valid when maybe you need child or daycare service up till 15 perhaps? Many credits and deductions are totally lost when taxpayers file separately. Married taxpayers file separately, yet others are split between the spouses. Only 3% of the taxpayers I see are married filing separately, but the tax consequences can be very harsh for those in that situation. It's not really a choice for many of the taxpayers I deal with, unable to file jointly for various reasons and unable to obtain a divorce for economic or other reasons. They face harsh tax consequences. One that I would like to have looked at is the zero base amount for married filing separate taxpayers who live together. A base amount of 1/2 of the standard amount would seem fairer to those in that situation. As an aside, the base amounts for taxability of Social Security have been around for a while and might be looked at for inflation indexing or increasing. Due to the current economic conditions and high unemployment in certain areas, many taxpayers are turning to micro-enterprise. I encourage a new look at provisions that are providing negative incentives to start up businesses. One issue that has arisen fairly recently with the increase in startup businesses is the earned income requirement for the child independent care credit. The allowable expenses are limited to the lesser of the two spouses' earned income on a joint return. However, if one spouse is starting up a business, is self-employed and incurring a business loss, not unusual for a startup, they will not be able to claim a credit for their daycare, even though the other spouse is working and earning a good salary. A minimum deemed income approach for a self-employed spouse, similar to that done for spouses with disabilities or full-time students, could resolve this issue. Not a large dollar amount, however, the introduction to microenterprise for some is to pay self-employment tax at net income of $400, yet not earn credit for Social Security until they have earned $1,090. Again, not a large dollar issue, but I suggest a coordination of these amounts be considered. Treasury Inspector General for Tax Administration in 2003, in an audit report, found that there were over 258,000 taxpayers in this situation when the Social Security limit was only $780. My last issue deals with the nanny tax. A difficult issue for many highly educated taxpayers. It is especially difficult for those with limited knowledge of tax law. In many states, home help or daycare providers receiving payment through a state agency or intermediate service organization are treated as either independent contractors if the work is done in their home, in the home of the service provider, or as employees of the low-income parents, or parents if the care is provided in the home of the parent. The typical parent is a low-income individual with limited education, no experience in filing federal income tax returns, let alone issuing W-2s and accounting for employment taxes. Non-filing and collection problems have resulted. This issue was identified as a legislative recommendation by the National Taxpayer Advocate in the 2001 annual report to Congress. The recommendations were to change the status of home-based workers to that of employees and deem that the state agency, or intermediate service organization is responsible for administering the payments and would be responsible for the employment tax implications. State of Michigan, and I haven't looked at other states recently, but state of Michigan has been progressive in this area. They established a agency agreement for employment taxes for home help workers. These are sometimes called shore service workers in 1994. However, that was the daycare aides who provide service in the home of the parents are treated as employees of the parent. There are several 100,000 individual home-based workers throughout the country based on the Taxpayer Advocates report back in 2001. I expect there will be more today. In Michigan alone, in an audit report by the Auditor General, there were 26,900 daycare aides providing service in the home of the parents, and the low-income parents are expected to pay the employment taxes and the nanny tax. Not a technical term, of course. Total payments are large. They were $280 million during the 3-year period of the Auditor General's audit from 2003 to 2006. A large number of taxpayers and a large number. I suggest that the recommendations of the National Taxpayer Advocate be considered as legislative proposals, or to mandate state agency agreements similar to the one that has worked so well in Michigan for home health providers. That would increase dollars to the Treasury, allow home-based workers to readily obtain the benefits of the Earned Income Tax Credit, and significantly reduce burden on taxpayers who basically don't have the knowledge to comply with the law.
And Michigan is singular in that sense, or you think other states, or that's the one you know about?
Yeah, the problem is nationwide. I can't account for the numbers in other states, but there are other states with agency agreements for certain types of workers.
Yeah.
glad to take any additional questions.
Just this last study that you mentioned, the National Taxpayer Advocate, does it cover recommendations throughout what you've talked about, or just specifically more on this?
The advocates studies cover a large number of recommendations in many areas. There's always legislative, or typically legislative recommendations. This is an area that's dear to me because I deal with a lot of home-based
Okay,
workers.
Right,
Yeah.
right, yeah, no, I think that's an important one, actually, yeah. Right, thank you.
Thank you very much.
Thank you very much.
Hi, good afternoon. A minute?
Want to introduce your...
Hi, I'm Bonnie Speedy. I'm the National Director and Vice President for AARP Tax Aid. We are a national program across the country and do taxes for low income, primarily seniors. With 34,000 volunteers last year, we prepared 1.5 million tax returns and assisted 2.7 million individuals, again, mostly seniors. Our volunteers come from all walks of life. We train them for 30 hours approximately a year. It gives us unique perspective from that to look at what's complexing to our taxpayers. With the 30 hours of training, it's interesting that once we get past a second year with a volunteer, in any given, in the first and second year, we lose half of our volunteers, and I think that's inherently part of the complication of the tax code. These aren't tax professionals; they're people who think perhaps
These are the people trying to help.
they're trying to help.
That's it, I get it.
That's sort of the point. And once we get them past that point, we have our average tenure is 6 to 7 years, which speaks a lot that once we can get people past that early hump. But I think that's part of the problem. It's so inherently confusing with a lot of different things I'm going to talk about later that it really takes a while for somebody to get a comfort level. I speak to you as a volunteer in that program, as somebody who comes from a pension world in my past experience, and a wife of a self-employed individual and somebody who tries to do our own taxes. As everybody else has said, my views are not that of my organization, nor have they necessarily been vetted for being cost effective or fair. But the thoughts are there are some areas that jump out that I'd like to talk to you about whether or not they might be helpful to help people comply with the tax code and get past some of the complexity. Choices in the tax code are pretty rampant. Choices are pretty rampant.
So you have to read everything this
Yeah, different standards apply to different types of situations, and I'd like to talk about a couple of those, but many of them have already been talked about. But even when we talk about the Social Security issue and married filing separately, you know, if you're apart a year, you don't get penalized if you live in separately for over a year. Now, for a head of household, that's 6 months. So again, why the different standard? It's just one quick, easy example that here's the intent is the same as to acknowledge at some point that the situation is not easy to be dealt with, but why have two different standards? Another area, obviously, is the child age. They've tried very hard to try to get to a single definition, but for child tax credit, it's under 17. For otherwise, it's under 19. If you're a kid going to college, it's under 24. I think at some point, we need to look at those things that are trying to address a certain situation. And as Marshall pointed out, even the education experience is another great example. Why would it not cover the whole thing? That just makes the tax code that much more difficult. Dependent care is a big issue. As one who doesn't have kids, and when I learned how to be a volunteer in the program, it was one area I had to do over and over again as I tried to pass my own test. Okay, I could take it out of my employer, and then I got to write it off on this form, and it's up to $5,000. But if I have 2 kids, and it's inherently difficult. Education with the 3 different types. It was with Hope and Lifetime Learning. It was fairly intuitive. Hope was your better deal. But you only got it for 2 years, so you just move right on to Lifetime Learning. But now you've got a deduction adjustment, so you really do have to sit there and figure out the whole thing before you can try to figure out which one. So perhaps there are better ways to deal with that, one or the other, an education credit, and try to find some middle ground on being fair. On ERSAC, I'm on the IRS Advisory Council, and one of the things, 2 issues we're working on now, I'll talk to both of them, but one of them is we're looking at a tax tool designed to help on the web people figure out tax law. And we were going through some of this yesterday and trying to find out whether or not you have to file. And the first one, it asks you whether or not you're going to get additional child tax credit. I have no idea until I do my tax return. I mean, I got to put everything in. So it's sort of this circular reference. You know, it looks like an easy question. It has 6 or 7 words,
no
but when
idea.
you look at what it is, you got to pull out the tax code, figure it out, and so you might as well go offline. It doesn't do you any good. The property tax, you know, individually may look like a good idea to take the real estate deduction, off and out of the itemized, but I think it sets a precedent of complication that if we can continue to go down the road of trying to pull things out of itemized and move them here and move them there, it just makes the tax law much more complicated. Again, it may behoove a lot of people, it may be very helpful, but just from the simplification angle, it doesn't simplify the process. It makes things more complicated to try to figure out what's out of itemizing, what's in itemizing, and where to go with all of that. The state tax deduction, if you itemize the year before, you have to go through this crazy calculation that in the 10 years I have done taxes for low-income people, one time has it actually been applied. So you go through this whole process, and very rarely is it ever applicable. Perhaps it doesn't have a lot of benefit anymore. If so, is it marginal enough? Should we continue to do that? For a long time, and frankly, I didn't know it needed to be done. Phase outs are complicated. I agree with a prior speaker that they should be looked at very carefully. There are better ways of dealing with them, such as the tax amount at the back end. This issue I don't think can ever be dealt with, but as a national program, we readily deal with the issue that a lot of these phase outs don't affect regional differences in standards of living based on income. It was a rural state, and we were talking about helping people at the EITC limit. And they laughed and they said, well, where we live, everybody but the mayor is under EITC limit. If in DC, that's a very different standard of living. So again, it's sort of an issue of complication first, but there's an element of fairness in that point as well. My personal task on ERSAC this year, which I took because of my background, was to work on the Pub 590 for IRAs, which is a 100-page publication.
What is it?
A 100-page publication on IRAs.
Oh, okay.
Every different type, every different category, and you know, when you look at a publication on a single topic that's 100 pages, it begins to tell a story about how complicated it is. So then we started looking at maybe how to simplify it, and we went out into the web and found all kinds of charts. You can't quite read this, but here's a chart that talks around only about rollovers and whether or not you can roll over an IRA to an IRA, an IRA to a SEP, an IRA to a simple. And the answers aren't just yes and no, it's yes and no and maybe. And to need a chart just for one aspect of taxability on IRAs, I think speaks a lot. Here's another one on maximum deferrals, cannot exceed $1,100 and $500. That's one. The next one is generally the lesser of 25% of compensation or $16,500. The next one is the same as that, and the next 3 are none, so there's no maximum deferral. So they're all 401 type plans. They all have, and this is just on the taxability. I mean, setting up these plans and administering these plans is a whole separate course, which is what I did in my background as I was a certified pension consultant. So I sort of know that part, but this is just the taxability side. And to think that a senior can go through this and try to fix, and we're not even talking about recharacterizations. I probably still haven't completely figured out recharacterization, but I don't do that anymore. So I think there's a lot of room, particularly in this area, to look at simplification. One thing that they did a while back that may be a nice precedent to look at is they got rid of a lot of the rules around tax, the 10-year averaging, and just declared one way to do the filed taxes. And I think in some cases, back to the choices, and there being too many of them, that sets a good precedent, and maybe it's just time to pick a way that is most fair to most people, and then just move forward. And to that regard, and in my work in pensions, we used to calculate for everybody what part of a pension amount was taxable and which one wasn't, so that when the senior on the other side of that 1099 got it, they could actually do it and put it on their tax return, and there was some hope of processing their own tax return. But I find more and more that we're getting 1099-Rs at my tax site, including OPM, where they are not determining the amount. And I think there needs to be some look at whether or not we can either simplify the process or maybe encourage or regulate, or particularly if there aren't a lot of options, and again, there aren't those options like there used to be in the past. To that regard, I'm real pleased to see that there is some movement in stocks and basis into getting that information out to taxpayers. And again, a good precedent that I hope we can see more of. The Social Security issue is complicated. I agree with the earlier speaker. There are better ways to deal with that. Perhaps one thing is just to get rid of the different amounts and use it as far as the tax rate. Because watching a senior trying to go through a Social Security calculation, first of all, they get confused on whether or not it's taxable after 65 because of the work issue around Social Security, and they tend to merge all that all together. So once you get them past that and let them realize it might be taxable, for them to try to figure out their own calculation is very, very difficult. The credit for the elderly is another issue that confuses many of them. They come in and think they will be entitled to something called credit for the elderly, and of course, 99% of them are not. I have yet to have one personally.
It's like getting the love
Yeah.
fare tickets. Okay, I'm the elderly now, I get this credit for that.
So maybe not a simplification, but at least an expectation issue when they walk in.
Better
And
information about it.
And again, what was the intent of it? It is a very small benefit, so are there different ways to deal with that that might make more sense than a credit designed for a very few amount of people? And I think that's one thing to look at across the board as we look at simplification, is that there are so many individual type credits and situations that we have dug very deep in a lot of areas, that perhaps there's a better way to look at things across the board. Those ages are one of them. One of those types of areas is, where do we speak to an age of a
Right,
person who's
yeah.
crossing a child to an adult, or when you are a senior, and to make them consistent. I mean, clearly the age of the April 1st following the year in which you turn 70 and a half seems like a very complicated age to have picked
Yes.
to be RMD. Let alone the whole calculation of trying to determine what is a required minimum distribution is extremely complicated, particularly if you have more than one investment. It also makes it very difficult for a senior to try to figure out how much to pay in taxes as they try to figure out, do I have a tax liability? How much is that tax liability? I take a stock withdrawal this year to pay a healthcare bill. That all of these offsetting transactions can be very complicated for a senior to try to figure out if they owe taxes or not. Also, to the EIC maximum age, again, at some point in time it might have made some sense, but for a single taxpayer to continue to have a 65 age requirement on EITC, which is a relatively small benefit as a single taxpayer, one, doesn't seem fair, although that's not quite your charge, but it does add a layer of complication to even have to worry about an age. And then again, when it doesn't seem to have a purpose, perhaps it should be looked at. Wondering about looking, as you know, as a manager of a large program, we looking at some cost benefit analysis of raising certain amounts and how that affects, you know, movement and changes otherwise. And I wonder, it made me think about the standard deduction and whether or not raising the standard deduction by 1,000, 3,000, 4,000, 5,000, what that could do to the amount of people who have to itemize.
Right.
And could that drastically affect that to the extent that most, if not all, people could get through
Yeah.
on an itemized? And maybe a drastic suggestion, but one to think about, then do you index for AGI for everybody else and just get rid of itemized altogether? I might be vilified in my neighborhood, but again, as a next step to really look and say, okay, is this serving the purpose? Is it what we want? Is there a different way to get to it that might be much simpler than Schedule A, which is extremely complicated when you start to get into all the tiny nuances within that. I as being the volunteer leader in this group, I get to hang out with some really interesting volunteers, one of which I want to go back and talk to you also. I agree with Marshall that the mileage rates are inherently complicated, just, you know, the different rates. You've got a volunteer rate, you've got, which hasn't been indexed in forever. You've got a charitable rate and you've got a business rate. It does make sense to have minimally two. Seniors have the inclination to want to volunteer, and it just seems kind of silly to have multiple rates. But as I talked to the volunteers, there was one, I remember sitting there with him at dinner one night, and he was talking about all the gyrations he went through to maximize his tax situation, all legal, but how he had taken interest-only loan and how he was paying with credit cards, and then he was taking a lump withdrawal out of his 401k every 2 years and paying off the
pay it
interest.
off.
And he had the whole thing
He
worked
had it
out.
worked out to a
And I'm
50
thinking, that's an extremely complicated process that it takes a brilliant man like Jack to figure out how to maximize it. And then I go to my tax site and I deal with Janet, who is the complete other side of that. She had to take a withdrawal from a reverse mortgage to pay medical expenses, took out a partial, paid all kinds of fees, didn't take out enough, had to do it again, and nearly had a heart attack because she thought she was going to have a $10,000 tax liability that we were able to walk through because she had an offsetting interest earned and
But
interest
that was
paid.
just like,
And, you know, I look at the disparity between the two of them, and that the complication is not making a fair tax code in some sense when you have a very educated person who understands the system at a sophisticated level enough to really maximize. And for many of the rest of us, or many of the people we serve, don't have the resources, the inclination, or perhaps even the education to go through the tax code. Back when I read a research that said half of the U.S. does not have the literacy rate necessary to prepare their own taxes based on the complication of tax code. That was 10 years ago. I suspect that number has dropped even lower. And then lastly, I know the IRS is being asked more and more to administer benefits or basically ideas about how to provide tax breaks or money back to individuals. And, you know, I shudder to go here a little bit because I know the clunkers wasn't completely successful and there was a lot of backup where the money had to go through the agency. But I wonder sometimes if the IRS isn't being looked to too often to administer all these types of programs and ideas.
Yes,
And one that came to mind, just as maybe another possibility of looking at something a different way, was the home purchase credit, which has some fraud issues because it's not being done at the time of the sale. So then people are filing for the home credit who don't have a right to file for it. Then perhaps doing it at the time of sale with asking them to bring in last year's tax return and filing the seller or the agent or whatever, filing through HUD or some other agency. They'd have to build some expertise and capacity, and I'm sure the IRS could share some of that. But again, maybe it shouldn't always be the IRS who has to administer these, because again, then what happens? They go through the tax code, and the tax code gets more and more complicated every time that happens. So perhaps there's some ways to look at that. And again, just more of a holistic approach, kind of looking across the ages, across the educations. And, you know, I don't know that that's been done with any kind of systemic kind of discipline to it. Again, somebody comes to Congress, has an idea about a tax code, and people dive deep and come up with a tax code, and then you have this thing that lives like this, and it's sitting right next to something that doesn't really look too different.
That isn't, yes.
And nobody goes back and looks at the two of them and say perhaps they should just be one, or some underlying, again, like the education should be consistent. And I think it's time, and I'm sure that's what you're doing, to do that kind of
Right.
look as
And
well.
there is, I will agree with what Alan said also at the beginning. I mean, there have been attempts, including the 2005 tax reform panel. It's a very high-level panel, very mixed group, trying to look at it holistically. Now, you know, so I think, you know, a lot of what we've heard here today, these are issues where it's just clear we could actually, just in pure simplification, ages, I didn't know about the mileage thing. I mean, it's odd. We should be able, there's so much room to actually do something. And I'm happy that the president decided to sort of focus on this and say, well, maybe we can make some progress here. Yes. Building on really things that people who are in the field know, and that people have looked at in the past, and then somehow or other we haven't actually taken the step of trying to do something. So I hope we can move that process.
Yeah, I think it's great that you guys are doing that, and we also very much appreciate the fact that you are asking for our input. And
no, it's very helpful.
Provided things that will be helpful to you.
Absolutely, you've all been really very helpful, and you've all stayed on schedule, which is really great. Austin had to leave because he was, in typical White House fashion, called to a meeting that he didn't know was going to occur till 5 minutes ago. So I'm basically going to serve as the chairman of the PERAB for this group, and thank you all very much. And we'll look forward to whatever you send us. But I will say we really are committed to trying to make some progress in the simplification area. If nothing else, this seems like one where we can move the ball forward some. So, yeah. Thank you very much.